Starbucks spent Arshichi years building what most global brands only dream about, a genuinely successful consumer business in Japan. 2,100 locations, mostly company-operated. A customer base that treats a grande latte like a cultural ritual. By any measure, it worked.
So when Bloomberg reported on June 10th that Starbucks is exploring the sale of its Japanese business at a price tag somewhere between Niten wo dol and Thandin it dol billion, the first instinct is something must have gone wrong.
It hasn't. And that's exactly what makes this story interesting. Because who is lining up to buy tells you more about Japan's economy right now than almost any macroeconomic report you'll read this month.
To understand the Japan move, you need to look at what happened in China 2 months earlier. In April, Erslok Starbucks completed the sale of a Yuruhisa stake in its China operations to Boyu Capital, a Chinese private equity firm. Enterprise value approximately $1 billion. At the time, most analysts framed it as a China retreat. Another global brand reducing exposure after years of regulatory friction, political headwinds, and fierce local competition from Luckin Coffee, which had grown from scandal to market dominance in under 5 years.
But Japan is structurally different. Starbucks Japan isn't underperforming. Those Nikkei FAC stores generate stable, predictable cash flow in one of the world's most loyal consumer markets. Japan's coffee culture, meticulously ritualized, deeply habitual, is exactly the environment where a premium brand can compound quietly for decades.
So why exit? Brian Nickel, who took the reins from Howard Schultz's successor in late Nissan Ir-sin, is executing a back-to-basics restructuring. The diagnosis: Starbucks had overexpanded, overcomplicated, and overinvested in international operations while the North American core softened. The prescription: shed the capital-intensive international commitments, refocus on the experience that made the brand, and return cash to shareholders.
Japan, despite its performance, fits the profile of what he wants to shed. Running Nissan stores in Japan means navigating Japanese labor law, Japanese real estate contracts, and a Japanese supply chain, all at scale, all from Seattle. Selling it to a local professional owner who speaks the language, literally and figuratively, is a financially rational move.
The asset is worth $1 billion. The buyers are eager. The timing is favorable. For Starbucks shareholders, it's a straightforward equation.
The interesting question is why the buyers are so eager, and the answer to that requires understanding what has happened to Japan over the past 3 years.
Japan recorded $100 billion in M&A deal value in 2025. That was a 93% increase year over year. And it wasn't a one-off spike. In the first quarter of 2026, deal volume reached $41.3 billion, tracking above the 2025 pace. Goldman Sachs has described the structural drivers as durable, noting that private capital structures, including insurance arms of PE firms co-investing in take-private transactions, are now a permanent fixture in Japan's deal landscape.
If you watched episode Sur C, you know the three forces powering this: the Tokyo Stock Exchange's corporate governance pressure campaign, the unwinding of cross-shareholding stakes worth trillions of yen, and Japan's demographic reality, hundreds of thousands of aging business owners with no succession plan and no natural buyer. Those forces haven't gone away, they're accelerating.
The governance piece is what makes Starbucks Japan so immediately attractive. The TSE has spent 3 years pushing companies, Japanese and foreign alike, to articulate their capital strategy, raise return on equity, and dispose of non-core assets. The results are measurable. Over 90% of TSE prime market companies have now disclosed capital allocation plans. Share buybacks in Japan exceeded $100 billion in fiscal year 2024, that's roughly 2 trillion yen, and dividends have more than quadrupled over the past decade. Over 84% of prime market companies now have functioning nomination and remuneration committees. These are not cosmetic changes.
The effect is that Japan is awash with investor capital searching for deployable assets. When Starbucks puts Nikkei 4 premium locations on the market, private equity doesn't see a problem, it sees a platform.
A buyer acquires immediate cash flow, a globally recognized brand, real estate leverage across Japan's highest traffic commercial districts, and the operational upside of running company-operated stores more efficiently than a foreign parent ever could from a different time zone. That is a textbook p-value creation thesis, and Japan is finally open to executing it.
The weak yen adds another layer. A deal priced at 4 fak to wufak billion yen translates to roughly nitang gudor to fontang iti dor billion at current rates, with the yen hovering near fak wuzit pay to fak lux against the dollar heading into the Bank of Japan's June meeting. For dollar-denominated funds, Japanese assets are effectively on discount relative to their underlying operational value. That discount has attracted a wave of foreign PE not just bottom fishing but making genuine strategic bets on Japan's post-reform trajectory.
There is also a competitive moat argument specific to Japan's coffee market. Japan is one of the most competitive coffee environments in the world. Dutor, Tully's, and Komeda's have each carved out loyal segments. But the real structural shift in the past decade has come from convenience store coffee. 7-Eleven, Lawson, and Family Mart sell over 1 billion cups per year at pak yen apiece, effectively destroying the mid-market. What that leaves standing is the premium experience tier, real seating, genuine espresso, a branded environment worth paying for. That is exactly where Starbucks Japan operates, and that positioning becomes more defensible as convenience stores take more of the volume market below it.
AP buyer who understands Japan's retail landscape can run this asset with a clearer strategic focus than a Seattle-based parent managing Yanman stores across 80 countries.
Here is the structural insight I want to leave you with. Starbucks entered Japan in Shinkyū-Luk as a joint venture with Sazabe League. That structure, a local partnership, limited control, shared risk, was not a strategy choice. It was the only viable option. Japan's market was functionally closed to foreign ownership at scale. Cross-shareholding networks, relationship-based banking, and insider governance made it nearly impossible for outside capital to acquire and operate assets cleanly.
14 years later, in Marseille, Starbucks bought out its Japanese partner and took full control. That move itself was a signal Japan's market was opening, incrementally. Another 12 years later, in Marseille-Nice-Luk it is selling, cleanly, competitively, at premium valuation to buyers competing to get in.
That arc, joint venture to full ownership to market sale, is a compressed history of what Japan's corporate opening looks like from the inside.
The same dynamic is playing out across dozens of sectors. Foreign companies that spent years building market access are now monetizing those assets into a buyer market that simply didn't exist a decade ago. And Japanese companies are on the other side of the same trade, unwinding cross-shareholdings, spinning off divisions, and accepting that being owned by professional capital is not a threat but a capital structure decision.
The Bank of Japan meets on June 16th, 2 days from now. Markets are pricing in a rate hike to each %, the highest level since the 1990s. If it happens, the yen strengthens, and dollar-denominated assets in Japan become more expensive for foreign buyers. The window on the cheapest version of this trade may be closing.
Whether or not Starbucks Japan ultimately sells, and whoever ends up buying, the dynamic it reveals is durable. Japan's assets, built over decades of the old economic model, are being priced, traded, and restructured in real time by a new class of professional owners who see what Tokyo's own corporate class spent 30 years refusing to acknowledge.
The question for the next decade is not whether this transformation is real. It clearly is. The question is which assets get repriced next.